morning. The bond market took a little dive yesterday, and we're going to discuss how that may help everybody with the rates. Good morning, Brendan Rendo with the Homes in Orlando team at Next Home Neighborhood Realty, joined by my partner in crime, Joseph Dionne of Appli Home Loans. Morning, Joe.
Hey, good morning. How are you doing today?
Doing okay. Just kind of curious because late afternoon yesterday, we saw the bond market take a pretty good dive.
Yeah, it was.
Just curious how that may help people a little bit with the rates.
So it's always interesting, right? Like you saw, and this is like something that I look at is usually once 4 p.m. hits Eastern Standard Time, we don't see anything else with rates, right?
Right.
It kind of just, that's when it closes, it kind of settles, like bonds kind of slow down. You don't really see movement. But all of a sudden at like 3:55 yesterday, we had Powell speaking, and he said some different things that kind of resonated and kind of got some movement, a little jumpiness. And specifically, he said that they may start easing on their rate hikes as early as the next Fed meeting, which is only in 2 weeks. Yeah. So there's a lot of we saw 50, 55, 60 bips of improvement in about a 30 to 45 minute window, but it was all after the markets closed. So we were like, well, we're not going to see any rate improvements today, being yesterday, right? So nobody really benefited from this. And we were all like, and we had to sit there and go, okay, well, will there hold into the next morning? And I think a lot of that improvement was due to liquidity and kind of like, hey, there's good news, but we're not here. What's going to happen? And it kind of just spiraled it up a little bit higher. And we have a crap ton of reports that were happening today, right? The biggest of which I think would really be CPI. Those numbers came out a little bit less of a gain than they expected. So that's good. But we've kind of seen the market kind of just a lot of those gains from yesterday after hours, we lost them. Not all of them, about half of them we've lost. And I think really we're going to open up today maybe an eighth better than yesterday, maybe not. But this is one of those things where I think as these additional reports today come out, we could see rates go way lower and we can see a big day rally for rates and go down, or we can kind of just see them stay very volatile and kind of bounce around all day. And if that happens, lenders are going to be what? Conservative and nobody's going to win.
Yeah, because we've mentioned it before that the spread between the 10-year T and rates is rather higher than normally it is. And I think a lot of times when you have this much volatility in the market, you think about it, we've been all over the place the past 6 months. 2%, roughly 2% swings up and down in the market. I'd be a little nervous too and be conservative with that. Well, because when if we go and look at, here's the ticker right now on the 10-year T, and you can see right here, this is where we started yesterday afternoon, which is roughly sitting, pretty close to 3.75, and it dived all down to 3.61 and kind of hold around that 3.6. So that's 0.2 of a point in a bond shift. That's a big shift in a day.
Yeah. Well, I'd like to I'm kind of curious if you go back a month on the 1 month on that, right? And as it loads up, and let's see if we get that load up, because really, when was Hurricane Ian?
Yeah, I think so. Is this the 1 month? That's 1 year. Sorry.
Oh, that's 1 year. I'm like, so 1 month Hurricane Ian was it the 10th? Was it that first week? Yeah, right around that.
Yeah, right around here. Yeah, November 8th.
So you kind of, I'm curious, and you see that movement from then to now, in the 1 month, that's a lot of movement downward. And Hurricane Ian that day, and was when we saw our best single day gain in like drop in rates, right? Like historically, it was like one of the biggest drops in rates. And we've given back a little bit of that. But the weird part is as we gave it back, we haven't quite seen the market respond to why are we giving back as much as we have when it comes to the rates, because it doesn't look like the market's going, like everything's pointing that rates shouldn't be going back to where they were, and they haven't, but we're still lower, but but what's happening is banks are kind of going, and we saw this like that one day, I floated down anybody I was locked, I refloated, basically renegotiated the rate, floated down, got a better rates, right? And now when you do that, banks basically say, hey, you can do this, but there's a cost to it. So let's say the cost was 50 bips. So you really want to see 100 bips improvement to justify this, right? Well, we watched all these banks say, okay, we can do this. And then all this volatility, they lost it all really quickly. So a lot of banks ended up losing their asses. And what ends up happening now is all the banks making it more strict. And now you need even bigger gains in the market to be able to do restructures or renegotiations on float downs.
Renegotiations, yeah. I mean, because if you look at it, we're down 0.6 of a point within the month, basically from, about the 5th, 6th to today, that's a big drop. And you're right. We have seen, improvement in the in interest rates, but you would think it'd be a little bit bigger than what we've seen.
Yeah. So, and you wouldn't think with what we're seeing in the market that we would be giving back as much as we have. Like, we saw a big swing down, and then it's like, all right, well, we improved 0.5%, but we gave 1/4 of it back. And it's like, well, why are we giving it back? We're still lower than where we were when we got that improvement. So definitely interesting. And I think it's exactly that. It's a lot of conservative approach to, banks are saying, hey, like, it's just very, very volatile and we can't lose our ass. Like, we got to make sure we're protecting ourselves. And everybody's doing it, though.
Yeah.
So it's not like
a lot of them are nervous that with the Fed, people who've been in the business, you get a feeling for the economy. And, like with the announcement he made yesterday, pulling back, I think a lot of them are looking at, wow, our rates could be back down in the 5s next year, which again, we've talked about this, means that they're going to lose a lot of the loans they're sitting on right now due to refinances. Because if you can decrease your interest rate an entire point, you're going to do it. You're going to do it in a heartbeat. So I think a lot of them are like, well, we've got to be able to make as much as we can up front to cover our costs because we're going to lose these loans. They're coming off our books. Yeah,
and they're not like, you're going to see, and it's always the fun part. A lot of people are like, oh, well, if their portfolio has these higher rates, like that's great. Like more investors are going to want it. It's like, no. Investors don't want that because they know that if it's too far off of what the new rates or what the estimates are going to be at, that all those are going to come off the books anyway. So they're not going to get that big return. So it's kind of I think you're exactly there. There's a little bit of defense being played right now because for mortgages, it's usually 9 to 10 months payments before they even hit a break-even point from the cost. So if that note is, if they, if it's like, we get to like, if it gets refinanced in month 6, 7, 8, like whoever wrote that mortgage is losing money. Like, so they're not profitable on that mortgage.
Not a fun place to be. So the other interesting news we got this week is conforming loan limits. Taking a nice jump. Yeah.
And this was the official announcement. We've seen a number of banks already start allowing to limit loan to this, but they were hitting some pricing hits and stuff like that to give you the ability. But this is kind of, it's a big jump. And the high balance is the first time ever that, you're going to have Fannie Mae, Freddie Mac back loans, so to speak, that are guaranteed over $1 million for
over
the
a
high
million
balance.
dollars. Yeah,
That's
yeah.
crazy.
Which I think there may be one or two areas in Miami that hit that high
Yeah, not
loan limit.
much. Not much.
A
I
lot
think
of
the
it in
Keys might
California.
have it as well. Yeah, California benefits, Hawaii benefits, a lot of areas not in Florida benefit, but it feels like Florida should start to get their way into that market with the way prices have gone up.
Yep.
But yeah, it's definitely really, really good news. It's good to see that kind of go up. And then I'm curious, we haven't seen FHA announce their numbers officially, but FHA will always go up and they always mirror a similar increase. So
Yep.
FHA, I believe, is going to be around 426, somewhere around there, I think.
Yeah. Because where are we right now with FHA?
Man, you hit me with that question off the top of my head. FHA loan limit, Florida. Because FHA, that's not accurate. We're at 420, I think we are right now for FHA for 2022, 420. So we're going to see it bounce up. I'm curious. Let me take a look and see if they projected the new number here while we're kind of talking.
Because their increases generally aren't quite as much as what the conforming limits are.
It's usually a similar percentage. It's a percentage based, if I'm not mistaken. I don't recall the exact structure of how it increases, but it's if conventional goes up X percentage, they're going to go up a similar percentage. So, and that number hasn't been announced yet, though.
Okay.
But you're talking from 647 for conventional to 726. Those are big numbers. That's a big increase.
Yeah. And what a lot of people realize is that even if prices decrease, once they've set that, it doesn't go down; it stays there.
Mm-hmm.
So, which is good. You know, if you see some price decreases coming through on houses, you still got that higher loan limit, so you can fit it under conforming and don't have to worry about doing jumbos. You know.
Yep. Yeah.
So look, those are two of the big things that are going on right now, and then looking at our numbers for the week, sales, which this kind of makes sense because this is actually going through November 20th. We dropped to 217 sales again this week. So our sales volume, and a lot of it again has to do with interest rates and people just backing off. And we're not the only ones. We're seeing it across the country. We've had now 5 months of decreased sales numbers throughout the country. But our median price is holding very constant. We're sitting at that $400,000 level. And our inventory is really kind of sitting pretty tight, which I expect that going into, the holiday, November, December, you tend to see less new listings come on simply because you've got the holidays. A lot of people don't want to be moving or selling their house, right before the holidays. Then generally, that first weekend of January, you all of a sudden kind of see a big jump in the number of listings that come out. Then we go back into our numbers, which this is the one we've been watching really closely, is the original list to sales price. We're still sitting here where, we're looking at on average a $31,000 decrease from the original list to the sales price. And when we get into, some of the primary markets, which is, your 300,000 to 400,000, you're coming $20,000 off the original list price.
Yep.
That's a big drop. That's, going up to 500,000. That's a 5% drop off the original list price. And then you hear, from the final list, you're still getting about $11,000 off. So, that's 2% at 400,000, just about 3%, 2.5%. Well, people are still getting, some good concessions in their negotiations.
Yeah.
And you're seeing it increase even more at this 500 to $1 million range. They're sitting right now about 95% of original list price. So when you're looking at making offers to people, these are the kind of things you look at, and you look within a subdivision itself, and actually go through and calculate, ooh, okay, this is generally where things are kind of going. Gives you a real good idea. And then our days on market, we're sitting there at that 42 over a month, which historically that's about average. So, we're not, it's not an abnormal market, but you just feel like you've slowed down so much because you were at such a pace for 2 years. And then you see our graphs, median sales price, it's holding, just holding steady. We're really kind of just leveling off at that $400,000 mark. And then you see our sales, beginning of the month, we were 203, which that was around the hurricane time. We jump back up. These are probably some delayed closings, I would assume, from the hurricane. But then we jump back down to 217. So because it'll be interesting to see if people are able to, like you do for a lot of your clients, able to adjust a little bit and see if the little bit of give back in the mortgage rates pushes a couple people over the decision process to, okay, I'm going to go ahead and close. Because big advantage of pushing and closing in December is that you get the homestead. You get to file a homestead for the coming year and take advantage of that tax benefit. And I know I always go through that with people like, well, maybe we should close mid-January. Well, here's where your payment starts. Here's where this payment starts. But you're going to get that tax benefit. And these days, your homestead tax benefit, in that $300,000 to $400,000 range is going to be probably about $500 to $600 savings on your taxes per year. Do you want to, for 15 days, you want to give up this, $500 or $600? Is it really worth it? And they're like, oh, gee, no, not really. Okay, good. Yeah. So, and you just see average days on market, again, holding pretty steady overall for the market. Total actives, here's our inventory. And really since, end of October, we're just kind of holding steady. And I expect to see that through the rest of the year. I really do.
Anytime you hit the holidays, a lot of people at this time, you don't see as many people put their houses on the market. They want to get through Christmas now before they list.
Yeah, exactly. So those are our numbers. It's getting to be a fairly consistent overall number. I don't see much changing going into the end of the year. I think we're gonna stay fairly consistent for the next couple of weeks. I think the big thing to watch is just, like you said, the reports coming out. We got the Fed meeting. I bet you if we go on and look at the betting on that, I bet you everybody's pulled back from the 3/4 to maybe a half.
I think that's the projection, is everybody's thinking a half this time.
Yeah, because a lot of the news you are seeing out there is layoffs here, Amazon, layoffs at FedEx, which really this should be their busiest time where they should be expanding.
That's the big, that's what kind of threw me for a little bit of a loop. Like you said, FedEx, Amazon, this is their season.
Yeah,
this is usually when they're hiring. And they're laying people off. So it's like, okay, but then you see news reports of like biggest Black Friday shopping season ever. I feel like we're getting a little bit of mixed news. I think maybe there's some smoke and mirrors and those type of announcements. But it is definitely one of those where, you are starting to see, you're seeing a lot of the tech industry. I think the tech industry right now, they're the ones taking the brunt of it,
Yeah, they are. Yeah, I mean, Meta laid off. Was it 1,000 people?
More. I want to say it was like 5,000 or 6,000. I could be wrong. I could be.
Yeah, it was just an astronomical number, and you're just going, holy cow!
And that's that's the big one. You see these big you see all of that going on right now, and it does draw some concern, right? What's going on? CNN just laid off. Had some layoffs.
Oh, darn.
Right. I think their parent company, whoever their parent company is.
But I think Powell may be looking at that, and I think the unemployment report is going to be the big one to watch over the next couple of weeks.
Mm-hmm. Yeah,
because
that's going to
we
be.
start, as we mentioned earlier, several months ago, is the one to watch is the unemployment, because the employment rate was holding up. That was the one thing that was holding up the economy.
Yeah,
and kind of holding up housing still, was we still had a good,
yeah,
what were we like, under 4% unemployment, somewhere in that
mm-hmm.
ballpark. So if you start seeing that creep up, I think that maybe that's what Powell's looking at, going, ooh, we've got some big unemployment numbers coming. So
yeah, and that's the hard part and that's what I'm kind of curious to gauge, is how does it really impact? Because we've seen like unemployment's been at historic lows, like layoffs have been, even with these higher elevated layoffs, it's like there's still low numbers in the grand scheme, and it's still going to put us into kind of like historical norms for unemployment. But how the market reacts, it's going to be kind of interesting to see. Does the market overreact? And do we see kind of a snowball effect of, other companies start getting more conservative because they see what's going on and they go, oh, we gotta adjust, and we gotta plan for the worst. And we start seeing that happen, across the board. And I just pulled up the number real quick, which I thought was interesting, was there were, in the tech industry, it said that there were 12,600 layoffs in October, according to layoffs.fyi in the tech industry in the U.S. And then November, there were 50,000.
Wow.
So that's a big jump.
That's a big jump.
But in the grand scheme, still relatively small. The one concern, though, is the tech industry, those are not entry-level wage positions. Those are all
those are good paying jobs.
Higher wage roles.
Yeah. Yep, those are very good paying jobs. That is a number we are going to have to continue to watch. Definitely. Mm-hmm. So, all right, sir. Well, I appreciate your time today. Thank you so much. Anyone has any questions, always feel free to reach out. If you're watching on Facebook, please like. If you're watching on YouTube, please subscribe for our weekly updates. Thank you so much. Have a wonderful day.
Sounds good. Rock you guys.